What's up, guys? Victor here. In this weekly episode, we'll be discussing inflation, the Fed, and a potential trade I'm evaluating. Let's start with the Fed. The first thing to consider is what is the Fed trying to optimize for? Their key objective is to prevent high inflation regime. Really, the Fed is thinking in a world which is high inflation regime or low inflation regime. Bringing high inflation regime back to low inflation regime is extremely onerous on the economy, so they try to prevent it at all costs. Moreover, they will be trying to prevent stop-and-go inflation such as one we had in the 70s, which is almost as onerous as high inflation regime, so they will really try to prevent that. The second thing to consider is the data. The data that the Fed is targeting is lagging. CPI, PPI, consumer inflation expectations, etc. If you bring the objective and the data together, the conclusion is the Fed will most definitely keep tightening for longer and will not pivot until they are sure that they brought the inflation down in such a way that it will not re-emerge. So now let's discuss the market, putting aside the Fed. There are, as we all know, risks, earnings, inflation, recession. Emerging markets are starting to be worrying as well, with the appreciated dollar. The emerging market governments and companies often borrow in dollars, so now it is becoming more expensive for them to service their debt. Europe also worrying with the gas situation, and if it gets any worse, it will throw Europe into a deep recession. So while we have these risks, there is tons of capital waiting on the sidelines, a lot of dry powder, and as soon as we have resolution to any of these risks, this capital will get deployed very fast. In this bear market, we really haven't seen any significant rally yet, so we should expect rallies as soon as any of these risks dissipate. But in my opinion, we shouldn't expect the bear market to turn into a bull market until we have more clarity on when the Fed will start easing. And of course, once we are in bull market, there's still the risk of a stop-and-go inflation and its implications on asset prices. Let's turn to weekly performance. So for the week, we basically ended where we started, but within the week there were some significant moves. On the 13th, we got in the morning the CPI print. Market reacted strongly, negatively, but recovered very fast. Continued to decline though till the evening. On the 14th, again in the morning, we got the PPI print, and later in the morning, the FOMC member Bullard gave speech. Market reacted positively, and on 15th in the morning, we got the retail sales, positive news, and we also got option expirations on Friday, so that might have contributed to the positive price action as well. From a factor point of view, high dividend outperformed, growth underperformed, but really not by a significant margin, no strong direction this week. On the yields side, short duration yields up, long duration yields down, most likely reflecting the CPI print where the market is expecting 75 bips in the next hike, but potentially a recession in 3-year time horizon. Turning to key data, so just to recap, the US showed 9.1% annual CPI in June, compared that to 8.6% in EU. This is probably the more important chart from Fed's perspective, and we can see that the consumer inflation expectations for the next 5 years are starting to tick up. And if the Fed sees this as too worrisome, they will act aggressively. This chart perhaps shows why the Fed is afraid of high inflation regime as much. It shows that at a low inflation rate, really inflation is limited to specific categories of services and goods. But as we get to a high inflation regime, inflation starts to show across the board. These self-feeding dynamics are hard to stop, and hence it is hard to bring down high inflation. On a positive note, and as discussed in previous weeks, the 9.1% CPI print we saw this week might be the top, as we are starting to see supply strain to ease. Also important, the labor market. While we saw strong jobs report data last week, we have indications that the jobs market is starting to slow down actually since March of this year. And perhaps most telling are new job openings on company websites, which you can see are red across the board. Turning to a trade I want to discuss this week. So, if you look at performance of S&P 500 as compared to DAX, the European index, what really I found interesting is that year to date, S&P 500 and DAX performed almost exactly the same. Does this make sense? Well, at first sight, it did not make sense to me, and I tried to think about why this is. Perhaps the first explanation why this is the composition of the indices. The US index S&P 500 is more heavy on growth, which performed relatively poorly this year. You can see the Nasdaq at minus 27%, while the European DAX is more value-oriented, more consumer cyclical-oriented, and if we compare that to Dow Jones index, that index actually outperformed. So that is one explanation. Perhaps the second explanation might be the mismatch in timing of interest rate hikes in the US as opposed to Europe, where Europe is behind. So this is the history. Looking forward, my bet is that European indices will underperform the US index. Why? The risks in Europe are higher, and the ECB is just now starting to hike interest rates. If you look at another aspect to consider, the currencies, we can see that actually year to date, the currencies were a significant contributor, negative contributor to European performance. Let's take an illustrative case. If we were to invest $100 at the beginning of the year, where the exchange rate was $1.13 per €1, we would have 88.5 euros, and at that point the DAX price was 15,900 euros. So really, at the beginning of the year, we would be able to buy this much of DAX. Today we would have the same amount. The price since then dropped by almost 19%. So in euro terms, we would have 71.8 euros. If you were to convert that to dollars, well, the currency exchange rate dropped by 11.5%. So today we would have $71.8, which is a loss of 28.2%. Looking forward, I don't expect the dollar to start depreciating much. yes, the ECB will start hiking, but I think there are other factors that will outweigh this positive driver of euro. So I think that is a sensible trade. I'll try to evaluate it more. And as a side note, Ray Dalio and his hedge fund Bridgewater over the past couple of weeks have been taking the same or similar position. They are short more than 10 billion worth of US stocks, European stocks. Turning to next week, so in the beginning of the week, we will have data on the housing market, key driver of consumer confidence. So on Monday, housing market index, Tuesday, building permits, Wednesday, home sales. On Thursday, we will have manufacturing index, unemployment claims. On Friday, services and manufacturing PMI. Also, earnings starting to fully ramp up. You can see here on the slide what companies will be releasing what earnings which day. That's it for this week. Thanks guys. See you next week.